Did you know that since 1977, Warren Buffett, the sixth richest person in the world at the time of this video, has written one letter every year to his shareholders in Berkshire Hathaway. These letters are packed with time-tested principles and techniques he used to build his fortune, starting from just $228 of his first investment at the age of 11. I spent countless hours analyzing all 46 of these letters and have distilled them into 8 key rules, and by the end of this video, you will know exactly what they are. Buffett's first rule revolves around an invisible boundary he never steps outside of. He believes in investing what you understand and staying within your circle of competence. He has applied this rule in all of his investments. In 1997 letter, Buffett discussed his acquisition of Dairy Queen, a business he understood deeply. Why? It's simple. Everyone knows ice cream, and the business model hasn't changed much over decades. During the dot-com bubble in 2000s, he avoided tech stocks because he didn't understand them, which protected him from the massive losses that many other investors suffered by investing their money in a trend rather than within their circle of competence. Building on the idea of investing in what you understand, Buffett warns against the cigar butt approach. In his 1989 letter, Buffett explains it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Buying a mediocre company at cheap prices is what he calls the foolish cigar butt approach. A cigar butt found on the street that has only one puff left in it may not offer much of a smoke, but the illusion of a bargain purchase. He calls this the bargain purchase folly, which he learned the hard way after making losses on various investments. Buffett likes companies which have strong competitive advantages or economic moats. Economic moats come from brand power, a technology which is very hard to copy, or many other factors. He then likes to buy these good businesses when the market undervalues them. Now, understanding the quality of a business is crucial, but so is understanding market psychology. And what does Buffett do when the market is in chaos? In his 1986 letter, Buffett famously said, "We simply attend to be fearful when others are greedy and to be greedy when others are fearful." What Buffett means is that the best investment opportunities often arise when the market is in panic mode. And conversely, the biggest risks come when everyone is overly optimistic. Buffett practiced this during the financial crisis of 2008. While many others were selling their stocks in fear, Buffett was doing bargain hunting and invested over $13 billion in good businesses whose shares were selling at big discounts. How Buffett profits from market chaos closely related to the market psychology is how you handle market fluctuations. Most investors fear market volatility, but Buffett welcomes it. In his 1993 letter, he wrote, "We welcome volatility. A wildly fluctuating market means that irrationally low prices will periodically be attached to solid businesses." Buffett sees market drops as sales on great businesses when he goes on bargain hunting. So a bit like Black Friday, but for businesses. Now, while volatility can present opportunities, there is a common game in investing that Buffett avoids entirely and sets him apart from many other investors. In his 1988 letter, he famously said, "Our holding period is forever." Many investors make the mistake of trying to time the market, buying low and trying to sell high. But Buffett has repeatedly said that this is a losing game. In his 1992 letter, Buffett wrote, "We've long felt that the only value of stock forecasters is to make fortune tellers look good. Even now, Charlie and I continue to believe that short-term market forecasts are poison and should be kept locked up in a safe place, away from children and also from grown-ups who behave in the market like children." Buffett doesn't try to predict where the stock market is going. Instead, he focuses on finding good companies to invest in. If you believe a company will do well in the long run, don't worry about short-term changes in its stock price. Now, surprisingly, one of Buffett's most powerful strategies involves doing nothing at all. In his 1990 letter, Buffett said, "Lethargy bordering on sloth remains the cornerstone of our investment style." There are many years when his company Berkshire Hathaway didn't buy or sell any major shares. What Buffett means is that good investment opportunities are rare, and when they do come along, you need to act decisively. The rest of the time, it's best to have cash ready, sit tight, and do nothing. This patience allows you to avoid making impulsive decisions based on short-term market movements. In his 1991 letter, he said, "Our stay put behavior reflects our view that the stock market serves as a relocation center at which money is moved from the active to the patient." Now, another cornerstone of Buffett's philosophy is to avoid leverage. Buffett is a strong advocate for avoiding borrowing, also called leverage in the investing world. In his 2010 letter, he talks about how using borrowed money has been a way to become poor for many people. He talks about how when leverage works, it magnifies your gains. Your spouse thinks you're clever and your neighbors get envious. History tells that leverage all too often produces zeros. I'll let that sink in for a second. Businesses which have a high debt can easily come to their knees without cash and are a risky investment which Buffett tends to avoid. But even Warren Buffett makes mistakes, and he has always been open about his investing mistakes, including his costly acquisition of Dexter's Shoe Company, which led to a $3.5 billion loss. In his 2007 letter, he called it the worst deal of his career. He has also publicly talked about missing out on opportunities to invest in companies like Amazon, Google, and Microsoft. Buffett acknowledges that a couple of really big purchases were served to him on a platter, and that he was fully capable of understanding them. In his words, "The cost of this thumb-sucking and not buying those businesses has been huge. All investments go up, some will go down for sure." But Buffett never let these setbacks define him. Instead, he thoroughly analyzed what went wrong, learned from those errors, and adjusted his approach moving forward. This ability to learn and adopt is crucial in the ever-changing investment landscape. So, in summary, understanding your investments, avoiding the temptation of bargain stocks, being contrarian, welcoming volatility, practicing patience, and avoiding excessive debt and learning from your mistakes will set you up for investing success. And when it comes to financial mistakes, many people regret lacking discipline in managing their money. If you are interested in saving money to start investing, you might enjoy this video where I discuss how I saved my first $10,000.